and welcome. My name is Nicola Corzine, and I'm the founding executive director of the Nasdaq Entrepreneurial Center. We're delighted to have all of you joining us today. Now, if this is your first time or you're back joining us again, the Nasdaq Entrepreneurial Center is a nonprofit whose mission in the world is to really help our entrepreneurs from all over the globe realize their maximum potential and thrive. We are here in support of all the amazing dreamers out there building great companies and legacy and impact for all of us. So thank you for all that you do to make this world a better place. As you may have seen in the chat, and as you may have seen on that opening video, we've launched a big movement this year coming out of COVID around mentorship. Isolation has taken on a whole new twist this last year and a half. And what we want to do now more than ever is be in support of our entrepreneurs and getting them connected to the experts that they need as they pivot, as they grow, as they scale up their businesses. So if you have some capacity to give as a mentor, or if you're looking to be able to tap into experts who can help you realize those dreams, we'd encourage you to take a moment and sign up for this opportunity. It's available and free for everyone. And we're really hoping now more than ever that we can connect you with one another and connect you with the help that you need to build those businesses that we're inspired by. We will be opening up for Q&A today throughout this session. So we would encourage you to make sure that you use that Q&A function that you'll see at the bottom of your screen whenever you have questions or as we go throughout today's discussion. Now, none of what we do at the center as a nonprofit would be possible without the amazing, generous contributions of our sponsors and our supporters. So for all of them who believe in the work of the center and believe in the power of entrepreneurship, thank you. For Nasdaq, Lehigh University, Bank of the West, Wilson Sonsini, KPMG, Woodruff Sawyer, and BPM, we're incredibly grateful and thankful for all you do. During these unique times, we've actually been measuring how our entrepreneurs are faring. We know the wellness of our entrepreneurs is really required in so many ways. So I'm going to launch a poll really quickly to just ask you to quickly let us know how you're doing today. This information is kept in-house to us, but it allows us to sort of get a real pulse on what our entrepreneurs need now in these times and as we continue to build programming for the center. So I'm going to get everyone a chance to sort of just reflect in real time. How are you doing coming in this specific time out of COVID and still with so much uncertainty around everything that is out there? A good deal of optimism as we always expect from our entrepreneurial base, but also many of you who are a little anxious and still hanging in there and surviving. We understand and appreciate your honesty and your authenticity in responding to this question. I'll end that poll and share the results just so that you all know you're not alone in how you're doing right now. Thank you very much. Now, without any further delay, let's get started with the incredible content that we have today on SPACs. Please join me in giving an incredibly warm welcome to our panel today. Up first, we have Claudia Saraf, Global Head of SPAC Listings at Nasdaq, Jared Faze, Director, Deal Advisory and Strategy and Accounting Advisory at KPMG. We have Remy Karenbelt, an Associate at Wilson Sonsini, and Priya Huskins rounding our panel out today, Partner and Senior Vice President of Management Liability at Woodruff Sawyer. I'm going to invite each of them to give a very quick introduction of their background, and we'll start it off with Claudia.
Thanks, Nicola. Great to see everybody. Thanks for having me on today. My name is Claudia. I am based in New York. I've been at Nasdaq just over 12 years. I do run our global SPAC efforts and work with privately held companies exploring a traditional IPO on the East Coast. It's been a busy year to say the least, but an exciting one with more to come. And I really look forward to this panel today.
Fantastic. Thanks for joining. Jared, over to you.
Perfect. Thanks, everyone. Jared Tice. I'm a director in our deal advisory and strategy practice for KPMG based out of Seattle. I primarily focus on capital markets transactions, so IPOs, SPACs, direct listings, mergers and acquisitions, and the like. And recently I've been working with quite a few SPAC clients, mostly in technology or technology adjacent industries for med tech, fintech, prop tech, anything that has a tech after it. And some other also industries such as luxury goods and the travel space. And I've worked with actually both foreign and domestic targets too of SPACs, which we'll touch on a little bit later.
Exciting. Thank you, Jared. Remy.
Hi, all. I'm Remy Kornblit, a senior associate at the law firm Wilson Sonsini, Goodrich, and Rosati. I sit virtually in the Seattle office. I practice in our corporate and mergers and acquisitions group by virtue of Wilson Sonsini's traditional focus on growth companies, technology, life sciences companies. We advise more so the operating companies that go through the SPAC process, less so the SPACs and sponsors on the exploration and execution of de-SPAC transactions. And I, like a lot of folks, have been very busy in the industry.
I think that is going to be a continual theme for sure. Thanks, Remy. It's great to have you. And Priya, over to you.
Apologies. Thanks, Nicola. I'm Priya Huskins. I'm one of the partners at Woodruff Sawyer. We are a commercial insurance brokerage servicing clients worldwide. I'm an expert in director and officer liability for SPACs, de-SPACs, IPOs, public companies, and late-stage private companies. I chair Woodruff Sawyer's D&O claims group, so I have a lot of data points about what can go wrong and right.
Well, an exceptional panel here. We're going to hopefully find out a lot more on the what to do right and try to avoid as much of the what to do wrong pieces. But let's get started. It has definitely been a busy year. Before we do that, we do want to get a quick temperature pulse of who is joining us today. So we're going to launch a real quick poll up, inviting you to respond to what pathways are you considering right now to access the public markets. So if we could ask all of you to just kind of quickly let us know what you're thinking. That will help guide our time together as a panel in responding to the questions that you have and just sort of help us know of all of our audience joining where we need to be spending our time today. I'm going to let that run in the background just for a moment before we end it and share those results. And while that's going on, Remy, why don't I sort of get the conversation started with you, if you don't mind. Could you speak a little bit about some of the considerations surrounding projections in this current time?
Sure. Thanks, Nicola. It's a great question. And projections is really a prime example of a situation where the traditional practice and rules around an IPO versus a merger and acquisition transaction don't map cleanly onto the SPAC process, which is a theme that you'll probably hear me revisit a few times in the course of the discussion. In your traditional IPO, SEC rules strictly limit sharing anything resembling projections by the company going through the IPO process. Whereas in an M&A transaction, Delaware and SEC rules have settled on the fact that projections are actually critical information for investors to make a voting and investment decision, and it therefore has to be shared. This is a situation in which we're more on the M&A side of the line in the S4, which is the SPAC offering document. So operating companies and SPACs can really use this as an opportunity to tell their forward-looking story to the market as part of the going public process in a way they wouldn't otherwise be able to in an IPO. Obviously, that's really most helpful for pre-profitability or growth stage companies. But I think any public company management team will tell you about the risks and headaches of having to share projections, forward-looking information, things like that, particularly once you start setting market expectations about providing regular reports or obligations to update stale projections when you speak to the market as a public company management team. And the wall of disclaimers that you see in the S4 really won't prevent plaintiffs' counsels from scrutinizing the projections that are put out there in the context of stock drop cases for these newly public de-SPAC companies, which we're seeing more and more of in the context of the totality of the disclosure provided to the market. So management teams need to be really careful to balance their optimism, which we saw the poll. There's a lot of it going on, which is great. Their optimism for the business with the risks of painting kind of too rosy a picture that may not really play out as expected and may get them into trouble. So we try to advise teams that they should really think about the projections as their best guess as to the future performance of the business and be careful about overly aggressive projections, reach projections, or scenarios that assume that everything will go exactly how they plan and they can execute 100% on the plan. Also need to be really careful about multiple scenarios or multiple cases, like if you have an upside or a downside case, or also need to be really careful about changes in projections or the plans throughout the SPAC process, which might, one, complicate the disclosure that you need to tell the market, and also might undermine the assertion that the projections represent the company's best guess as to future performance, which is really the guiding light for what you tell the market.
Really sage advice in there. Thank you so much, Remy. Now, I want to sort of go back perhaps to one of the most foundational questions that has got to come up for all of you in various ways time and time again. And in fact, as we saw, a lot of our participants today are thinking like IPO maybe still. So Clavia, to you, can you help kind of ground the conversation on the difference between kind of considering that traditional IPO versus a SPAC? What should founders and companies be keeping in mind?
Thanks, Nicola. Yeah, so I think, SPACs used to represent about a single-digit percentage of the number of IPOs when it came to raise or number of IPOs. Today, they're well over 50%. I think it's going to be pretty consistent double-digit percentage going forward. Now more than ever, we're seeing companies exploring different methods to go public, whether it's a traditional IPO, a direct listing, or a SPAC. Now, we don't think that the SPAC is going to be a replacement for the traditional IPO, just another option that companies can look into when they're evaluating a path to going public. If you look at the types of de-SPACs that have happened on Nasdaq, these are high quality names that could have gone public through a traditional IPO. And so the difference, frankly, is frankly, that it is different for each company, but at the end of the day, the end goal is to be public. Now, there are some advantages that I think we'll cover later today, but if you think about it holistically, a SPAC IPO investor is looking for yield with optionality. They're looking to participate in a business combination, and they can redeem if they don't like what they see. The investors that are getting into the business combination are doing due diligence on the business, and whether they like the target that the SPAC sponsor chooses, that certainly is a factor. And then there is certainly a great demand for high-profile sponsors, what their business combination will look like and how they perform. And there's always going to be an interest for high-quality deals if the sponsor can find that high-profile target. If not, then there's the redeem option. Early days, many sponsors had, the private equity background, but it's a very different investor base today that's going to include former CEOs, VC firms, bankers. Certainly had an incredible year for IPOs, over 123 billion across more than 512 IPOs, especially if you include SPACs. So it is changing the types of sponsors, the quality and the nature, the types of sponsors involved, and the types of companies getting out is certainly very, very different from previous generations. And there's going to be immense opportunity with potential carve-outs and other M&A going forward. But the SPAC option gives a third viable option for a founder to seek an exit and for their investors to seek exits. And today, we're seeing the lines blurred across IPOs, SPACs, and direct listings.
Blurred lines and maybe enthusiasm, it certainly seems. And perhaps picking up on that theme a little bit, Priya, I'd love to invite you to share sort of from your perspective, what have you been seeing when it does come to that enthusiasm rating and that level, both to form new SPACs and also potentially being acquired by SPACs?
So Nicola, I had expected that the interest in SPACs to abate, given all of the SEC scrutiny and frankly, just the sheer volume of SPACs that are already out there looking for companies to acquire. And I was super wrong. I think there was like a 36-hour pause and then it was totally game on. Now, having said that, I do have a lot of clients telling me that their bankers are saying after Labor Day. So I guess we'll see here really soon. On the de-SPAC side, it is definitely a tale of two cities. I've got clients that are enthusiastic about de-SPACing as a route to going public, and I have others that are deeply skeptical. Now, in the skeptical pool, I think you have on the one hand people that had always thought about an IPO, always focused on that outcome, and it's just frankly too late to pivot at this point, and so they're sticking to their guns. I also think in the skeptical pool, there's some concern that a de-SPAC transaction may be somewhat inadequate compared to an IPO from a branding perspective. But my prediction is that as the de-SPAC market matures, the pool of skeptics will get smaller. To Clavia's point, this is increasingly just another way of going public.
Well, Darren, I'm going to flip it to you and ask some of those incredibly important and tactical questions. What about some of these implications around warrants and earnouts and honestly, the accounting implications behind them? Anything that we need to be mindful of in this current market?
Yeah, so, and I won't bore everyone with all the gory technical accounting advice and guidance. I'll try and keep a little bit higher level for folks. It certainly is a complex analysis. I'll just level set with that. So, predominantly some of the issues around, as you mentioned, the warrants, which come in both private placement and public types of warrants, and then also earnout provisions. So different instruments. And if we think about a SPAC, ultimately, as Remy alluded to, it's a merger, right? And so there's negotiations that take place, there's a merger agreement, et cetera, and all those type of things. And so some of these instruments actually take different forms and have, for the most part, most SPACs have very similar warrant terms, but they can take on slightly different forms as a company negotiates through that process. And so, prior to April of 2021, and why that date's important is that some of the SEC staff made a statement on some of the accounting associated with warrants and different provisions. But prior to then, basically everything was equity classified, and that was just kind of what everybody did. And 99.9% of the SPACs out there have similar terms, and they all kind of form as equity for that reason. After the SEC statement, what they did is they focused on two pretty general provisions that are in most SPAC arrangements associated with indexation and tender offer provisions. And I won't go through all the gory details, but with indexation, it's referring to the ability for those instruments to be settled in an entity's common stock. So, and then GAAP has very specific rules and criteria around how a company does that. And so what the SEC said, though, is the holder of the warrant being a characteristic in that it doesn't allow it to meet that treatment under GAAP and therefore has to be liability classified. And I'll touch on why that liability classification is important in a second. The other provision with the tender offer, it allows, as we alluded to, there's certain redemption provisions or other types of provisions that exist within the warrants arrangements. And what they can do is actually agree to settle, certain instruments in cash. And because the warrant holders would have different provisions for net cash settlement than all common stockholders, that also under GAAP precludes them from allowing equity classification. And so ultimately that would result in liability if that provision exists, which it does for many of the SPACs out there. And so when those are liability classified, it requires a measurement every reporting period at fair value. And so now you have a change in that liability on the balance sheet, and then you have that change that occurs being reported in earnings each period. And mostly that applies to a lot of our SPACs that had to go back and restate and do all these things when the SEC announced that back in April. But now on an ongoing basis, what's also impacted is a lot of these, targets when they go through a de-SPAC process don't think that I'm going to have to maybe pick up a liability through this process. And certain of the arrangements, like the earnouts or the private placement warrants, can survive the transaction, requiring the liability classification for the target post-SPAC and remeasurements, et cetera, et cetera. So just understanding that and those settlement provisions and things is key. And then also as we look ahead, now to as new SPACs are forming and IPOs, it's starting to be a consideration on, should we adjust those terms and have different instruments and those things so we don't have to deal with this liability classification. So I know, Clavia, you were going to touch on kind of new formations at this point as well.
Sorry, Jared, you kind of broke up there at the end.
Oh, I was saying, would you like to touch on new formations, and how companies are now thinking about with warrants and different arrangements of them?
I'll let some of my colleagues touch on that. Remy, perhaps?
I think you're seeing a lot more creativity in how SPACs are being formed. People are, look, a lot of the concerns around the SPAC process is, are we properly incentivizing the SPAC public market stockholders, right? Are they in it for the long run, or are they just looking to, get a warrant and redeem? On the flip side, for the companies is, are we targeting the right level of dilution for, what may or may not deliver a lot of cash to the company in a high redemption scenario? So I think SPACs are getting creative about how to structure their securities, their redemption incentives, their warrants, and really the transaction itself, the business combination with the opco to make sure that all those incentives are properly aligned. And again, we're seeing new things. They're not all successful, and some of them are even being challenged by the SEC and litigation, as we've seen with the Starboard case, which I'm sure we'll touch on at some point in the conversation.
Mm-hmm. So we've got creativity playing in, obviously. And Jared, I'm going to ask you, do targets also have a lot of power right now? Are they finding themselves with a lot of weight to be able to be creative?
Similar to Priya's remarks earlier, I would have said 3 or 4 months ago, this is probably a different answer to this question. I think right now, over the last several weeks, month or so, we've seen a general decline overall in, SPAC markets, particularly with the PIPE investment. I think there's just been a lot more caution at play, and I think we're hearing a lot that after Labor Day, there should be a pickup, right? And so I think in general, there's not as much power probably of some of the targets to execute a transaction at this point. But I think that's probably going to alter in the future, especially as we get through some of this regulation and people adapt to that. As we mentioned earlier, there is a lot more pressure being put on with some of that regulation. So particularly on some of the valuations, and what I've seen is companies 3 months ago had a great valuation. I'm worth $3 billion, and then they go through the PIPE process, and all of a sudden they're saying, we don't really feel good about that. We don't feel good about your projections or anything like that, and we think you're $1.5 billion company. And that really changes the equation for some of these targets on what they're trying to seek for funding commitments, like all those things as well. And so, it has certainly changed over the last couple of months, kind of the overall, optimism in the market and how much valuation you can achieve. And one thing I know too is the U.S. market overall is fairly saturated from what we're seeing. And so a lot of the U.S. targets, particularly those that would have been good candidates, as Claudia alluded to, IPO direct listing is on the table. IPO markets are strong right now. A lot of our companies are going straight IPO at this point. But I think there has been a lot of those target companies already approached and have made their decisions on would I like to go SPAC or not. And so we've seen a shift now into some of the international companies, so international targets and U.S. SPACs going after, those type of companies. I would say that those from an SEC perspective, they usually qualify or they try to be structured to qualify as a foreign private issuer in that sense. And so we are seeing, with a broader global perspective, being able to register on the U.S. SEC and, have that tap into those markets and the valuations and things. I think there's a broader sense of international targets now being approached by U.S. SPACs. There are quite a few different rules, though. So if we just touch on the foreign aspect, a lot of them qualify as IFRS through the transaction. They want to. They're already IFRS companies, so International Financial Reporting Standards, which differs from U.S. GAAP in certain regards. And they can report under that under the SEC, but may have to do certain reconciliations or other accounting treatment and reporting under that. Also a typical foreign private issuer only has to report 6 months and annual information with the SEC. But we are seeing, just with that kind of market power and pressure that the U.S. demands, is that a lot of these companies are adapting and going to be reporting on a quarterly basis because that's what their analysts and investors and others expect as they compare themselves to, U.S.-based competitors and peers. But there is some certain, accounting treatment and those type of things in reporting as well that goes along with it. My previous topic of warrants, we can actually end up in a different treatment, potentially equity or liability, amongst other, issues with foreign private issuers, particularly around regulation and those type of things as well. So I think we're going to touch on that a little bit later, but what we're seeing overall from a market power as well, because my last point here is, a lot of it has been technology company based. As I mentioned earlier, a lot of my clients are technology or technology adjacent. So anything within those realms, med tech, autonomous vehicles, those type of things that are kind of what everyone's talking about these days, has a general, more influence or power at this point. Some of the other industries that are more, older or consumer retail focused or luxury goods, those are seeing less power in the market overall.
Really helpful. Thank you so much. Priya, I want to turn the conversation a little bit to an area that I think is talked about a lot, but with a lot of uncertainty. Could you help guide us on what are the roles and responsibilities of directors in SPACs? Because they are sort of specified and very important for us to realize as we enter into this conversation.
Yeah, I think it's a very important question. And I'm going to take it in 2 directions. And one is the legal requirements, and the other is commercial. Like, why are they there? And from a legal perspective, for all that SPACs can feel novel, there isn't a lot new here when it comes to what's expected of a director. SPACs are public companies listed on a major exchange, and so the rules apply. And what that means, from my perspective, is a recommendation that potential directors should plan to bring the full boat of their director skills to the assignment. And that means having regular meetings with board materials and minutes afterwards, taking committee assignments seriously, albeit it's really mostly audit, and meeting an executive session. And that can, when I say it like that, it can feel burdensome, and yet that's what you do for a publicly listed company. That's what a SPAC is. Now, from a legal perspective, after you get through what is just table setting, the show is diligence. And we know from heightened scrutiny from the SEC and others that this is so important for directors to take extremely seriously. And so that means full process with regular checks at the request of directors so that they can actually demonstrate that they are exercising their oversight duties, including through documentation. So that's the legal perspective. From a commercial perspective, of course, what does a SPAC have? It has the talent of the team, and that includes the directors, and directors are often chosen not for governance per se, but because of their stature in the business community, their contacts, their proven track record around M&A and the like. I will tell you from a downside risk perspective, the fact that you have directors who are skilled at public company work, understand the process of taking a company public, and in that sense could give guidance, and frankly are potential board members for the target. That's extremely important, and that's the other thing, that's the commercial thing, and it's also important. But I would be doing everybody a disservice if I didn't make a big point of reminding everyone how important just the director as director role is from a legal perspective.
Director role, first and foremost. I love that. Thank you, Priya. Well, I not that we want to spend all of our time worrying about the stick, but certainly the SEC enforcement has been an interesting one to watch over the last little bit of time. What do you think? This is an open question for everyone. It is really teaching us about the year ahead when it comes to SPACs. What is this wave of enforcement really helping us think differently about in this time? Remy?
I can jump in here. Sure. I think it's telling us that the SEC is treating these a lot more like IPOs than M&A transactions, which is, probably appropriate. I think most companies will look this more as a going public situation than a change of control situation, which it isn't on the OpCo side, right? And what I think you're seeing is more scrutiny around disclosure. Making sure the investors are informed, making sure they're aware of the risks. And the SEC is really focused on that. And particularly with, the special situations around SPAC transactions, which may give rise to, or at least the SEC is focused on potential conflicts around SPAC directors and the target companies in which they invest. After all, the SPAC is essentially a big pile of money. Right. And so the decision by the board, which, as Priya pointed out, is kind of the fundamental director decision in which they need to exercise their fiduciary duty of care and loyalty, is, well, what do we do with this big pile of money? Who do we give it to? Right. And so I think the SEC is again, treating this more like an IPO with multiple rounds of comments, which is delaying the overall timeline for what used to be more of an M&A situation. So I think they're looking at it more critically in that regard and applying the kind of doctrine of investor protection that they would to an IPO company versus, a mature public company with a history of SEC reporting that is going through an M&A transaction.
Any additional comments?
Yeah, I might weigh in there too on the fiduciary duty of the SPACs. I think to my comments around valuation, we did see quite a few of the companies that completed a SPAC merger, their valuations dipped and their stock prices dipped after they went public. And the SEC caught onto that. And I think now, as we've seen some public statements made around increasing the, enforcement or review of diligence procedures done by the SPACs. And, that has caused, to Remy's point on timing as well, not only the SEC comment period on that, but also just overall the diligence being put forth, financial, legal, tax, has certainly increased an overall level of effort and also the amount of time it takes to complete that diligence and really ensure that that target is ready to be a public company and those projections are solid and all those type of things that go into, a company being listed on the exchange. And so, I think we're seeing more and more of that and creating that viability and sustainability of the public company long term as opposed to just getting them to being public.
Flavia, would you like to add to this?
I think that covers everything. Sorry, go ahead.
No, I wasn't sure if that was for me. Sorry.
Neither was I, actually, so thanks. So I may be having audio issues on my end, so I apologize. No, I think that covers it at a holistic level.
Awesome.
Nicola, I would add something if I could. So in addition, we all keep saying take the diligence seriously, and there's a reason we all keep saying that. If you look at the Ability software, Momentous, or Nicola enforcement actions, that's the theme. The theme is do not say in your disclosure that you did diligence as a SPAC if that is actually not as super true as you're making it seem in the disclosure. So that's one. The other thing is this, I do think the SEC's heightened scrutiny, and that is absolutely the word for it, underscores the importance of working with advisors that do this a lot. A lot of them are represented on this call. What you do not want to do is enter this process on the cheap. And if that feels like the best route, you may want to reassess your SPAC plans because it is serious. It is not, two guys and a dog, and the dog is the brains of the operation. This is a very serious undertaking, and you need serious advisors that do this a lot. And the fact that the SEC keeps showing up, they're not going to be less interested in this for the rest of this year and into next year.
Well, speaking of keeping things serious and focused, I want to stay with you and invite you to speak a little bit about some of the D&O insurance considerations that are hitting within the SPAC market currently. What advice and trends are you seeing currently around this right now?
Yeah, so D&O insurance is an area of profound frustration for all of the insurance buyers right now. And I completely get it. The prices are very high. And the prices are high because the insurance industry is putting their capital behind individuals and groups and making bets. And some of those bets are really not going very well. Remember, D&O insurance carriers experience no upside. It is only downside risk for them. And so my first thing I'd say is take seriously this issue of getting D&O insurance. You need it for independent directors on both a SPAC and a de-SPAC, if nothing else. And that process needs to be afforded time and attention. On the SPAC side, the cost has gone up 4 to 5 times compared to this time last year. So for a SPAC, the first $5 million of D&O insurance for a company with a U.S. address on that S1 is probably between $750,000 and $850,000. Remember, this is a 2-year policy. If you have a non-U.S. address on the front of your registration statement for your SPAC, that means that you will not be able to access U.S. capacity, and the non-U.S. market is worse than the U.S. market when it comes to pricing for D&O insurance. Right now, your cost might be double. In other words, you really want to try, and even Cayman SPACs very often can have a U.S. address on the front. You need to talk to your lawyers about what's appropriate. This is not about misleading, but it makes a big difference on your ability to access the U.S. market. And timing is also a tremendous issue, and it's hurry up and wait. You need to get in front, get in queue, select your broker that does this a lot early on. Your brother-in-law that is super good at your auto is inappropriate for this kind of insurance. You need somebody that does it and does it directly. There are 40,000 commercial insurance brokerages in the United States. There are probably 4 that reasonably do a large volume of D&O insurance for SPACs. You want to be talking to somebody that does this a lot and is not using an intermediary, but doing it directly. And with all my hurry up, get in queue, get your broker, you're not going to get quotes much outside of 30 days before you start listing. Insurance carriers want to know who you are. They want to know that you're in queue. There's a whole process there, but they will not release quotes right now less than 30 days before you're going to trade, which is incredibly frustrating and also underscores the need to understand the budget ahead of time. If somebody is telling you it's half as much, you need to ask a lot of questions. It is a market and there is a market clearing price. On the de-SPAC side of the universe, you want to compare the cost of D&O insurance for a company going public through a de-SPAC to the cost of a company going public through a traditional IPO. That's the kind of the mindset to consider. And at this time, if all things are equal, and they never are, but if all things are equal, the cost of a company going public through a de-SPAC transaction, the cost of their D&O insurance is going to be higher than for an IPO. So for an IPO, the first 10 million is trending on average to be about $2.5 million. So $2.5 million for the first 10 million of insurance. That's over a $15 million self-insured retention, like a deductible on average. Bigger companies pay more. For a de-SPAC transaction, you're looking at 20 to 30% higher for the cost of the insurance, and a self-insured retention, again, like a deductible, that instead of being 15 million is more likely to be closer to 20 million. Now, these are broad generalizations. These are averages. Your outcome will be absolutely dependent on the quality of your company, the quality of the disclosures, the quality of your board, and the process you undertake. Planning is critical for all of these kinds of things, but especially so for de-SPAC transactions.
And back to those two really important pieces of advice from earlier. Surround yourself with experts and don't think this is about doing it on the cheap. Like, really have to watch those two elements. Thank you so much. I want to move to a little bit of the media. Always a fun conversation for sure. You know, they're certainly saying right now that SPACs are quicker than traditional IPOs, although some are taking longer than expected or estimated, perhaps. Could we maybe, Remy, Jared, Clavia, whoever wants to answer this, help us understand a little bit about what is actually taking this bulk of time and help maybe see around the corner of the time involvement in a SPAC?
I can start on this one, Jared. So yeah, one of the big advantages or alleged advantages of going through the SPAC process is that it's quicker, and it usually is, right? And we usually tell target companies to plan for a 4 to 8 month process for completing a deal from start to finish. And put another way, 3 to 6 months after you announce the deal, you can close it, right? Which gives you 1 to 2 months to get everything ready in the background. And the stuff that takes a long time is, you know, the diligence, as Jared mentioned, the negotiation of the transaction docs, the pipe process, roadshow, where you kind of collect pipe commitments, then you announce the deal, and then there's the whole kind of putting together the S4 offering document, going through the SEC review process, holding the SPAC stockholder meeting, and closing the deal. Those are kind of the key steps to a life cycle of a transaction, of a SPAC transaction. We've been seeing deals close on the longer end of that timeline recently. I think for three main reasons. The first one is, you know, is the private operating company ready? And just like in an IPO, it takes time for a company to get ready to be a public company. And Jared mentioned this, right? But you have to put together GAAP and SEC compliant financial statements, which is one of the biggest delays we see in getting ready to be a public company, especially for non-US companies who don't get to take advantage of the special exemptions for foreign private issuers and may not have US GAAP financial statements ready. That takes a lot of time to put together. The second reason, I think, is just kind of the overall cooling of the pipe market. Whereas I think in Q1 of the year, there was a lot of excitement and pipe commitments were usually oversubscribed. They have tightened up considerably since their peak, and it has been challenging to obtain kind of the the PIPE commitments that let the parties achieve their transaction objectives, which leads to either more time to go round up necessary PIPE commitments or a renegotiation, a revaluation of the deal between the SPAC and the target company, again, as Jared mentioned, that, to make the deal more palatable to the PIPE market. And then the third reason, which is probably the biggest delay between announcing a transaction and closing it, which we've already touched on, is SEC review and scrutiny has been much more intense. I think we all, as Jared mentioned, there was the warrant accounting issue that kind of put the freeze on a lot of both announced and pre-announcement PIPE transactions. We think hopefully that's been addressed by existing and newly listed SPACs. So we hope that's behind us, but we're still seeing multiple rounds of extensive review and comment by the SEC, which can take a few months to clear. And, either because they're swamped with SPAC filings or because they intentionally want to kind of cool heads in the SPAC market, the SEC has been taking the sort of maximum allotted time to get back to companies on their filings, which is 30 days between each filing, which can add a month each time there's a new cycle of comments. And it's not unusual to see 3 or more cycles of comments from the SEC.
Yeah, that's a great recap. I just added that there are a couple of controllable factors and uncontrollable factors. The uncontrollable factors, I would say, have outweighed the last couple of quarters. That's certainly the PIPE market to some extent, and we're hoping for a recovery in that space, although more and more deals, from what I understand, are exploring alternatives to that traditional PIPE market, the way it's been structured. Obviously, changes in the overall structure of SPACs are going to have an impact. And I think Ray brought up a great point, which is, are companies that are getting acquired ready to be public? And if they're going on a dual track, if they've been going on a dual track with the traditional IPO, you're seeing the maturity level of the financial process and the readiness process, which can be, a different world from, some of the other companies out there. But again, it's a learning process. There are a lot of very good, consultants out there, many of which are on this call today, obviously, and obviously the service community with the banking, the law firm world is doing a tremendous job in getting these deals out. I would say that overall, we have to remember that SPACs are filling a void of a certain size type of company that has not been able to go public the last 15 years. And so it has been, a tremendous value driver to the capital markets now that there is a third viable option to go out. We're always going to have changes when something new happens. But I think what the US and the global capital market system has proven, beyond doubt, is that the adaptability is there and the exchanges are there to support on the regulatory side, but also with resources as well. So I'll let Jared add to that as well.
Yeah, I think, to Priya's earlier point, advisors are key in this process. And one of the things I think, if you look back a year ago, everyone had a lot more capacity than they do today, and were able to take on, multiple deals at a time. Fast forward to over the last few months, a lot of service providers, lawyers, bankers, us accountants included, we're sold out, right? And so if you want to go and do diligence right now, a lot of companies, firms don't have anyone to do it. Or either that, or you're going to have to pay exorbitant rates to try and pull those resources from another, transaction. And so, I think just being mindful of that, we have seen some, I don't want to call it cooling, but with the SPAC markets cooling a little bit, it's freed up a little bit of those advisor resources, but just availability of people to help you through the process has been something delaying companies right now. I think something gets forgotten about a little bit, especially when we look at it from our foreign private issuers and those companies, they're foreign targets, tax implications and, negotiations that go on with that, right? And so there's a lot that gets negotiated and structured into the deal to create tax advantages for both sides, right? So both the SPAC, which is a U.S. company, and then the target, which is international, and would have to probably comply with other jurisdictions around the world as well. So it's very complex, and some of these structures take on a lot of forms just for tax reasons, which causes other complexities for everyone else involved as well, including then SEC comment periods and things that we're seeing. A lot of the foreign private issuers are actually going beyond, even 3 to 4 comment periods, which gets out to 90, 120 plus days, right? And so it's all of that is everything that the previous folks mentioned too is contributing to that. You put all that in a blender, it's making that, not a 4-month process, but closer to what you mentioned, about an 8 or 9 month process.
Be prepared for the longer run. Well, we are going to be transitioning here to Q&A in just a moment. Before we do, I'm going to ask our panel one last question. You can respond in whichever way you choose. It's either, what's the key takeaway that you would love for people to walk away with today? Or if you prefer, what is some lessons that have been learned, perhaps from some of the more notable recent transactions that you'd comment on today? Whoever wants to go first, would love to sort of get your advice on one of those two areas.
So I'll start. My advice is don't over-index to what you have seen most recently. You want to work with advisors that can help you look around the corner. And I'm particularly thinking about, in my world, the number of people that have told me with just tremendous authority that, you know what, all the risk for these transactions is at the time of the de-SPAC. Everything else, it's not a big deal. Now enter the SEC and the plaintiffs bar that have, oh yes, made a big deal of going after some SPACs and their sponsors and their Ds and Os before the transaction closes. And so for those SPACs that decided, you know what, a limit for a public company of $2.5 million is totally fine because it will never come up, they're now feeling very uncomfortable. And if they had spoken with the right advisors, what's happening now in a lot of ways is predictable, because as innovative as the plaintiffs bar and the SEC are, they do have a playbook, and we're just seeing them exercise that playbook. So that's my advice. The reason you work with people who have a broader view, perhaps, than just SPACs or just de-SPACs is because what we're seeing in this still fairly immature environment, what we're seeing there, we can predict the evolution in part based on what we see in other parts of the business of everybody on this call. And you are well served to work with people that can look around the corner for you.
I love that. Thank you so much, Priya. Remy, how about you? Advice, takeaway?
Sure. Look, I think, again, going back to the same theme, which is a SPAC kind of is a neither fish nor fowl transaction as between an IPO and an M&A process. And regulators, courts, the market, participants in the deal are still, trying to figure out what lessons can we learn from an IPO versus an M&A transaction, and how can we apply them to a SPAC to make it kind of the best possible outcome for everyone involved. And there's still a lot of uncertainty around kind of what the rules are and what the right practice is. And it's ever evolving, as Priya mentioned, and you really can't rely on what was going on a month ago to kind of guide your current transaction. One point that we haven't touched on in the panel, which is actually kind of critical to a SPAC transaction, is the dilution to the OpCo stockholders, right? And so dilution is just how much of the company the equity base is being given for no value or less value, let's say, and that's primarily in two main sources. It's the warrants and the sponsor shares. And for the sponsor shares, which are the promote shares that are issued to the sponsor as consideration for kind of organizing the deal, you can expect around, let's say 60 to 80 million of dilution to the company. And that's great when the transaction objectives are met and the operating company gets a lot of new capital infusion to its balance sheet. Less ideal when it's a high redemption scenario and you're going public, you're not getting a lot of capital to the balance sheet, but you're still taking on that dilution hit. And I think this goes back to what we were mentioning earlier about kind of creative structuring. You see, I think, a lot more willingness by sponsors to kind of be creative with the sponsor promote structure, put more at risk, let's say, based on achieving the transaction objectives. Possibly some forfeiture or earnout mechanism that's tied to the promote shares based on, for example, how much cash gets delivered to the balance sheet for the operating company, the combined public company post-closing. So I guess that's to say, in summary, Nothing is certain. Everything's changing. Good to be creative.
That is fantastic words to live by in general, Remy, but certainly very, very true for this topic at hand. Clavia, I'll turn it to you.
I'd say I'll touch on what Priya mentioned earlier is, maybe we thought that the market would slow down, and I wasn't surprised when it didn't. It was just such an immense interest in the space. I'm glad that it was, just a 36-hour, I'll quote Priya here, on, kind of a window that stopped. It was, I would say, the realization that there are so many companies out there seeking an exit they feel like they're ready for the public markets, certainly a good takeaway. I think there's more to come in this world. I think the corporate carve-out opportunity, the corporate-backed SPAC, and frankly, years of M&A that's happened that could frankly go the other way, and you could see some spin-off kind of opportunities where a SPAC sponsor can come in. I think it's certainly very exciting. I do think that there's some very interesting sectors to continue watching. I know EVs have been active, life sciences and biotech. But we think that technology, software are going to continue remaining to be a great opportunity, and then fintech. Fintech SPACs, I think, have a lot of opportunities. And as you see cross-pollination between sectors, whether it's tech and consumer tech and fintech, certainly in other financial engines, we think that there's tremendous opportunity to come in the sector.
Love that. Thank you for that great optimism continuing flow through. Jared, over to you. Round us out. What's a great takeaway from your side today?
I think I'd weigh on, and I think all the commentary has been great. And I might just go back to something I mentioned before about, and Priya said too, surrounding yourself with the right advisors, right? But that also, there's only so much that external advisors can do. And I think one thing I've noticed is a lot of companies need to have those internal folks as well in place. And the amount of effort, the SPAC is a lot of effort, and IPO is a lot of effort. Doesn't really matter. Going public, being a public company is a lot of effort. And it falls on people's shoulders to do that. And the amount of time that you can spend getting the right structure in place for your team, right? Do you have the right financial people involved, accounting people, legal, those types of things to create a sustainable company? I think so many of these deals focus on getting the deal done and getting to that point, and don't always look ahead and say, well, what am I going to do in Q2 or Q3 or Q4 when I now have to report as a public company and talk to investors, and I'm the CFO that's responsible for doing that, right? And with the number of companies going through this process right now, those people that are qualified and experienced and have those type of skills are becoming more limited, and so it's taking some companies a lot longer to actually get those people in place. There's only so much you can rely on, like I said, external advisors. So I think just being very cognizant of the people that are going to be going through that process, and this is the right thing for your company. We mentioned dilution and those type of aspects as well. A lot of companies in the tech space need capital right now to see their ideas to fruition, and they view this as a very strong way to get the amount of capital they need. But it's also, what do you do after you get that capital, right? And what does that money actually go to, and back to the resource front and other things that can go into that as well. So, I think just be very mindful about everything that it takes to actually go through the process.
Thank you, Jared. Thank you all. I mean, this has been exceptionally helpful as everyone sort of considers the amount of information out there and trying to navigate it all. Your words have just been incredibly helpful in so many ways. And as much as I wish that we could get to every single question that is coming into us live today, I know we're not. So on that note, what I am going to offer to everyone is a quick opportunity to identify, if you want a meeting with anyone here today, I'm going to launch an opportunity for you to identify that right now. This will just come into us on the back end. We'll be able to follow up with each of our partners represented here today. So you can go ahead and identify if you want to continue the conversation above and beyond what we're going to get able to cover today. Please let us know here, and we'll make sure that we get that contact information over to Nasdaq, KPMG, Wilson Sonsini, and Woodruff Sawyer to continue the conversation above and beyond the remaining time that we have. I'm going to let that one continue to run as we try to do our job and try to get to at least a couple of questions before top of the hour here. So let's start off in really trying to identify some of the questions that are coming in around the emerging markets. Angelo had asked, how many companies from emerging markets have we seen approaching the SPAC route during the past couple of years? And any indication on what sectors may be kind of covering in top of mind right now?
I mean, there's no question that there is a feeling that U.S. targets may be getting saturated. I'm trying to say it in a very optimistic way. I'm probably failing. And so without any question, I'm starting to see a lot of interest in Latin America. And also it does, and others have said this, fintech seems to be a space that has a lot of affinity for SPACs and de-SPACs.
I'll just build on that. I think we've had over a dozen SPACs launch focused on LATAM, China, and then ex-China Asia SPACs have always been very, very consistent. So anywhere between 10 to 30 or 40 a year. It's been pretty active this year. I don't have the exact numbers in front of me. And then several US sponsors have launched vehicles focused on exclusively, let's say, Southeast Asia or India. And I think the Indian SPAC sponsors will continue, showing some interest as that market continues to develop. So a lot more interest outside the US, and then the traditional European markets have been very busy. And we recently just launched, I think, two SPACs, two separate sponsors focused on the Middle East for opportunities, not just in the Middle East, but ex-Middle East as well.
I do wonder about the fate of SPACs focused on China in light of China's continuing announcements that are, very interesting in terms of how they're dealing with their own companies. And I'm obviously thinking about all the new rules about trying to get capital from outside of China, and the startling announcements about children and their use of video games. So, I mean, there's a lot going on there.
Yeah, without doubt. There's been a lot of questions, and I think we can all understand why, sort of wanting to dive a little bit deeper into some of the valuation shifts that have happened, perhaps after a company has gone through and completed the merger. Obviously, each case is unique, and so I'm not asking for anyone to sort of comment on specifics, but in general, broad speak, can anyone go a little bit deeper into why SPAC companies are seeming to lose quote unquote value after the merger? And honestly, anyone want to kind of cover some of the question on, are these deals potentially bad for retail investing in general?
I'm happy to give the worst case scenario so that other people can be happier. So let me just say that we have this phenomenon of either people with short positions putting out reports, or companies themselves shortly after the de-SPAC transaction needing to revise things in a negative way. A precipitous stock drop generally leads to a securities class action lawsuit. But think about the numbers. There were two of these. So post-close stock drop suits, there were two in all of 2019 related to de-SPAC transactions. There were 5 in 2020. Through mid-August, there were 19. Through mid-August, there were about 109 de-SPAC transactions that closed, so about 17%. In some sense, this actually just smells like what we see with IPOs. IPO companies, new public companies that take the traditional route, have a much higher rate of stock drop suits for exactly the reasons I just described. And so there's some sense in which I'm not surprised. New public companies are sued more often. They have bad news more frequently. And as much as there's such exuberance over a handful of IPOs every year, people have studied the phenomenon for years. And if you just buy a basket of IPOs, you're probably not going to outperform the market, probably to the detriment. I think we're just starting to see some version of that, but make no mistake, it's very serious when it actually becomes litigation.
Right. Well, I know we are at time. I'm going to try to squeeze in one last question and then thank everyone for their time today. And this is the question. It may not be the best question, but it's the one I'm going to take. And that is just a quick one. What's the take on the trend from the SEC of treating redeemable shares not as equity? Remy, I could certainly posit it over to you, but we'll invite anyone on that wants to kind of take that and close this out today with advice.
I'll kick that one over to Jared, if that's okay.
Oh, even better. Perfect. We'll go to Jared. Jared, close this out.
Yeah, so if I understand the question correctly, it's trying to understand treating redeemable shares not as equity.
Yeah.
Personally, and unfortunately, I don't have a ton of experience with it, but I have heard of it as being a topic. And I think it's back to what some of the things Remy mentioned earlier about just creative solutions that some of these negotiations are going through, and trying to understand, what are the cash needs, et cetera. And ultimately, I think as people get creative, the SEC is going to have a period of time where that probably gets out in the public, and then they respond to it, right, and react to it. So I unfortunately don't have a lot of other information on that right now, but I have heard it is an increasing trend. So.
Like we said, we can't predict the future. The things are always going to be changing, and creativity is the nature of entrepreneurship. So they'll just keep on being more and more creative as we continue to go. That's the fun part of this world. Thank you for your guidance. Honestly, it has been a pleasure to have the conversation for the last hour. We really appreciate each and every one of you taking the time to connect with entrepreneurs and all of those joining today. To all of you joining, thank you so very much. I am going to, because it's my job, launch one last poll as we go out to close here. And that is simply asking you to let us know, what more topics do you need the center to sort of put forward? As you may know, we build responsive programs in real time for entrepreneurs based on what their needs are. So this poll is going to help us make sure that we continue to produce content over the next 6 to 8 weeks that lets us do just that. And as we close out, again, a huge thanks to our panelists, to all of you joining us. Stay tuned for more great content to come. And please don't forget to take that survey for us on what more is needed from us. Again, thank you all, and we'll see you all soon.